Hey folks, Andrew Packer here and welcome to Trading Tips. I talk with a lot of different people about their investments. I talk with a lot of people who are interested in things like cryptocurrencies or, they just want to do commodity plays like natural gas futures or some crazy things like that. But one of the areas that I'm really surprised about is just blue chip companies, just large, well-established companies where you don't necessarily expect a lot of growth and where you really have to, kind of pay usually a little above average the market price to get into. But for some reason, people like this idea of stability. They like the idea of long-term dividend growth. And they like the idea that, hey, if the market's going pretty crazy, a company that has a history already of doing very well, no matter what the economy is doing or has survived in the past, well, that's exactly where they want to have their money parked, especially if they're thinking more long-term. Obviously, there are a lot of benefits to long-term investing. The tax rates are lower, or if you never sell at all, you get to essentially keep all of that money deferred tax-free. And that's one of the biggest secrets to the wealth of folks like Warren Buffett. So when it comes to blue chips, though, it seems like, hey, if I'm also a value investor, maybe I'm not going to be getting the best deal relative to the market. But what we say broadly isn't necessarily true when we get into the specifics, because there are always a couple of companies that are going through some short-term issues, and then people just sort of say, I don't necessarily want to touch this, and it gets to the point where it is a value, but it's also a good long-term investment opportunity. One of those right now is Minnesota Mining and Manufacturing, probably better known as, 3M, with the ticker being three-letter M's. Pretty obvious stuff. Now, don't let the name fool you. It's official long name. It's actually, going by 3M these days. It does very little actual mining equipment. They do some things. They make over 60,000 products, though, so it's definitely a lot more than the mining industry. In fact, you probably have plenty of these products in or around you right now. If you're watching this video on a computer and you've got Post-it notes sitting on your desk, well, that's probably what they're best known for today, is office supplies like Post-it notes. But it can be anything from the filters in your air conditioner to some of these other random parts that you see all sorts of places. So when you have a huge company that makes thousands of products that are used every day, you kind of get into blue chip territory, and people like that. Now, 3M, like a lot of other blue chip companies lately, though, has been seeing some weakness with its sales. They've been having a hard time getting growth. And some of their international growth has been a little slow with a lot of the trade war fears lately. So over the past 2 years, their chart price has essentially been a gradual move higher. And then after their first quarter earnings this year, they took about a 20% dive, knocking about 2 years of price appreciation off their share price. That's the kind of situation where I'm going to start to look at the company to see, hey, is this a good value here? And looking at the company, looking at the fact that it trades at about 17 times earnings, it's a little cheaper than the S&P 500 on average. Would it be better to get it at 5 times earnings? Absolutely. But when it comes to investing, a lot of times it's the relative value that matters. So looking at where the market is right now, it kind of passes my first test of, hey, this is a bit of a value check. So 17 times earnings. The other interesting thing is the fact that because of the sell-off, they're paying about a 3.5% dividend yield right now. Now, for some people who need immediate income, that kind of yield, well, that may seem a little low. But this is a company that's also in the dividend aristocrat territory, having paid out a dividend every year consistently, not missing a payment, and they've been increasing that dividend over time. So that 3.5% initial yield that you're getting today, well, that's going to change over time. The actual dollar dividend you're going to get is going to increase year in, year out with a company like 3M. Now, the third number is the one I've already mentioned, and it's at 60,000. Because the company's sales have been struggling, this seems like a really good opportunity for the company to maybe go from 60,000 different products that it has across a variety of sectors to maybe 50,000, 40,000, 30,000, who knows. But the point is, of these 60,000 items, there's probably maybe 1,000 that really generate 90% of the company's profit margins, and the rest of them are just sort of other things and add-ons. If you were a car company, for example, and you noticed that you were selling all your cars in the color green, you couldn't, make them fast enough, but you weren't selling any with the color red, you'd probably just stop making the red color after a while and you'd have one less product. Many products that companies make have these very small variations to them and count as a different product. So there's a lot of room just to consolidate, or there's even room to take some of these products and do a spin-off A lot of the blue chip companies will, they'll spin off to other blue chip companies. They'll buy portfolios of brands from other companies. There's a lot of activity that goes on in this space. But 3M definitely looks a little bit like a value play right now. And of course, with the decline in sales in the recent quarters and with some of the fears out there, there have been some comparisons of this company to what's going on with Kraft Heinz, and there are definitely some similarities. However, Kraft Heinz's biggest problem was goodwill. Goodwill is essentially a balance sheet problem. It says, hey, when we merge these two companies, the acquiring company had to overpay, so we're just acknowledging that we overpaid. In this case, the slowing sales just tells us, hey, we're going through some tough times, and maybe the economy is finally starting to slow down a bit and show some signs of wear. So this is a situation where a 20% drop on a quarterly earnings number is a great opportunity in any blue chip company to do a little digging and to look at whether or not this is something you want to look at for the long term. So in terms of buying shares of 3M, I like where they're trading right now. They've gone as high as 220 before the sell-off about. I would say they are a buy up to 180. That's going to get you a very nice discount from where they traded before. It's going to get you in at that nice dividend yield. It's going to get you into a dividend aristocrat that has been growing its income over time. It's going to put you in a situation where, hey, next quarter, if the news isn't as bad as people expect, even if they lose money and it's not as bad as people expect, shares could actually have a pretty good bounce from here. And with the stock market being a little bit kind of shaky right now on some of these trade war fears, that's holding things back a bit as well. So there's been a lot of downside priced in, and there are a lot of potential catalysts to send shares a little bit higher. So a year from now, you could be up 15, 20% and have that dividend. And that's the power of buying a blue chip investment when it is out of favor. So that'll wrap things up for this edition of Trading Tips. Until next time, I'm Andrew Packer, wishing you good trading and good financial health.